Want to welcome you guys early Valentine's Day webinar. I will be out for my friend's wedding tomorrow, but you guys know, please don't hesitate to reach out to me. I will be there for you guys and answer all your emails on Monday. But thank you guys for joining our webinar today. This is BPM RIA, Broward, Palm Beach, Miami-Dade Real Estate Investors Association, your only local chapter here in South Florida that is approved and in compliance with the National Real Estate Investors Association. My name is Alexa, COO here at BPM RIA. I do have some awesome people in the virtual building today. I have Anish here. I have Julie Lepore here. She's going to actually let us know what's going on in her world. She's going to help us understand FIRPTA. Hopefully, I'm saying that correctly. She's going to give us a quick guide for us investors here at BPM RIA. Anish is going to help us execute this today. So I'm really excited for that. And just to get us started on a super positive note, I will be raffling a free membership today. I will be paying somebody to be in this webinar today. So you guys, please enter the raffle. It's super easy. All you need to do is text the word membership right here, the word membership to this phone number right here, 954-800-6961. So go ahead and text that in to get a chance to win the raffle, which I will announce the winner at the very end of today's session. Guys, that is a $295 value. And if you don't have a membership, this is to go and win one, and hopefully you win. Good luck. Upcoming events, as you guys know, we are back from the National RIA Cruise. We are locked in. We have so many awesome events for you guys. And as you know, I am always adding more events to the calendar. So please always check the website right here. Literally, all the registration links are there for you on bmra.com. Click that upcoming events tab at the top, and you will see just a nice blog and a list of upcoming events, multiple pages, you guys. So as you see here, next week, we're going to discuss a 3-step blueprint to closing your first real estate deal in 90 days with our team. Really excited for the chance to win a free seat to our 2-day quick start. And I'm only telling you guys this because you're in here today. So go, 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 register for the webinar next week. Next week, we'll also have an in-person shop with Next Million Mastermind, our mastermind here in South Florida. We're going to discuss 6 exclusive AI tools to skyrocket your real estate investment success. Love, love, love this topic, you guys. As you know, I love to optimize my business, create efficiency, and just absolutely skyrocket success, like we say right here in this title. So we'll see you guys in Pembroke Pines, Total Wine. It is limited seating, you guys. So please RSVP, get your name on the list. I don't want you guys to miss out on this awesome networking and learning. And I did say Total Wine, so there's probably going to be some wine involved, you guys. So have fun and go meet people and get out there. Our boot camp, it's right around the corner, you guys. You know, this is going to be all weekend long, 9 a.m. to 5 p.m., both Saturday and Sunday next weekend. So not this weekend, but next weekend, we're going to have this insane, awesome boot camp that we only run this for 3 to 4 times per year. It's very limited. So you have to get in when we have it. If you haven't gone, you have to go. And then we have this awesome webinar coming up the following week, Hidden Real Estate Leads, No Competition, Big Deals. And you're probably like, how is this possible? No competition, big deals, where are they? Go to the webinar, register, and you will see this webinar is led by one of our founders in the Next Mill Mastermind. He's also the owner and creator of the Deal Finder software we use. Wink, wink. A lot of you guys know who this is. So please go to this event as you guys are going to see different strategies and tips and things that you want to get this big deals that we're talking about. And our monthly meeting, I know we just had a monthly meeting last night, but as you guys know, we did have to push it back a week since Anish and I were at the National RIA conference. So time is flying, you guys. We need to take action. We need to do things to make sure we are successful in this business. And we provide the most value through our events. So please attend as many events as possible. They are free. So it should be a no-brainer. So we'll see you at this free monthly meeting webinar, Winning the Negotiation Stack with Tom Zeeb. He is from Florida, so he understands our market, you guys. So please join us with Tom Zeeb on Wednesday, March 5th at 7 to 8 p.m. in a couple weeks. So my favorite way to keep up with events, it's super easy. Text BPM REIA, all one word, no spaces, to our event line to get those text updates for our events. You'll get the registration link. You'll get a reminder sent straight to your phone. It's super convenient and we absolutely love it for the convenience. So make sure you text BPM REIA, all one word, no spaces. Leave out the little quotation mark thingies. And I put all these details in the chat for you guys. So please go to the chat box. I'll be putting helpful links in the chat throughout today's session. So go ahead and check that out. Our quick start, like I mentioned, it is coming around the corner, you guys. It's so close. So please get the information you need to see if this training is going to help propel your business. And if you are getting into wholesaling, flipping, or rehabbing, I can pretty much guarantee you want to take this training. And since we have an actual money back guarantee, I would consider it the safest training for any of you guys to take. If you haven't even been to this training before, if you want to go again, I recommend it over and over again. So we hope to see you guys there. We have the 4 local business owners who are special guests on this training. Like I mentioned, 2 full days, all day Saturday, all day Sunday, completely led by our CEO and lead mentor. And I want you guys to go ahead and check out that link in the chat. And I guess I'll go ahead and say it in here, but I think you guys, if you guys are following us on social media, then you should know that we are running a Valentine's Day special right now, where if you bring a friend to the Quick Start, you guys get in for 50% off. So please, please go follow us on social media. Make sure you're following us on Instagram, LinkedIn, Facebook, all the platforms, and you will get those details if you DM us, if you comment, we'll send you the special code to get that 50% off. So make sure you go follow us and get plugged in so you guys can get that savings and get in the training. All right, members, as you know, you get all the goodies. You get in the 4 quarterly networking meetings we have per year for free. Your guests come in for half price, only $10 at those networking events. And then, of course, you get the amazing National RIA benefit package. So you get discounts to Home Depot, Office Depot Business, FedEx shipping, Rent Perfect, Millennial Insurance, Plan. The list goes on. So you guys will have discounts and benefits for all of the things you need as investors and also save on tickets, events, all that good stuff. So go get your membership now if you don't have it already. The link is in the chat for you guys, and you can purchase this straight from our website. So go, go, go if you don't have your membership already. Last but very not least, mentoring and coaching here at BPM RIA. Some of you may know we offer a fully one-on-one coaching program where you are matched with your own personal mentor, and we put up 100% of the money for our students' deals and split the profit 50-50. If you have no idea what I'm talking about, I invite you to go book a discovery call right now on our website on bpmreia.com. I dropped the link in the chat for you guys. I dropped my email in the chat for you guys, and I want to speak to each and every one of you one-on-one. I absolutely love these conversations where we can actually get to know each other and I can learn more about you and your goals and what you're looking for and looking to achieve and getting with us at the RIA. So please, please go book your discovery calls. I want to get with you. And then here I have this QR code on the screen where you can actually fund your education with this third-party funding. If you're interested, go ahead and scan that QR code. All you need is a minimum 620 credit score, $35,000 verifiable income, soft credit pull, and you get the response within the same day. So if you're looking to fund your education, investing in yourself, you can use this third-party funding that we are super awesome that we have this even available. So if you need me to email that to you, more than happy to. But you guys, I always want to take a moment to thank you guys for showing up today, showing up for your business, showing up for yourself. That's really what we're doing here. We are we're doing our grind. We are here to show up for our business and grow. So really appreciate you guys showing up. I always want to take a moment to thank all of the vendor partners that you see on our website. Please go check them out. Again, they're all investor friendly. They all want to help you. I want to thank, Julie for showing up today. Obviously, she's like so generous with her time and her knowledge. Thank you so much. Thank you to Anish for always, setting up conversations like this and allowing us to even partake in conversations like this. Like, it's not every day that you get to sit down with two CEOs and get a deep dive on what they know. Like, you guys, this is huge and we're so grateful. So please, with that being said, put all of your questions in the Q&A box. You guys see the Q&A box in your Zoom menu. Don't forget it's there. We want to hear your questions. We want to answer them. So go pop those questions in the Q&A box. I'll be chatting with you guys throughout today's session. I'll ask Julie to drop, any social media, any links in the chat at the end or whenever she wants to, because you guys know we're going to try to ask as many questions as possible in the next hour, but we don't want to miss what you guys are saying. And also, if Julie's cool with it, we will record today's session and post it on our YouTube channel. So I'll get confirmation from her after today's session. So just so you guys know, go subscribe to YouTube. And yeah, without further ado, I would like to bring in our guests and Anish, of course. Please,
Yeah.
how did you, Julie? How did we get here?
So first of all, I do see some new names that are on our webinar today. So my name is Anish Dave, CEO BPM RIA, formerly known as BRIA, the Broward Real Estate Investors Association. We're the largest chapter, national RIA chapter here in South Florida. I'm a real estate investor, licensed mortgage guy, licensed realtor. Pretty much almost, I feel like I'm licensed for everything. Out there. No, I'm not. Obviously not. So actually, first of all, I'm going to give a quick shout out to, and I see his name on here. I'm happy he's on the webinar, is Alejandro. So we always talk about what do you guys want to hear? So Alejandro is one of our students. Actually, he was also on the National RIA Cruise. And one of the things he said was, man, there's so many international real estate investors that buy here in South Florida. What about FIRPTA? What about this? What about that? Right? And I said, you're right. We've never had a webinar about this. So he did make me do some work. And one of the things at BPM RIA, we have a massive network. So I reached out to many guys that already know him, Kevin Thatcher from Independence Title, and I asked him, who's the best that you know that could actually teach this? And he goes, that's super easy. Julie, you want the best? I got the best. So Alejandro, again, this webinar is about because you picked it. We also, as I mentioned, if there's other topics that you guys want to hear, email us or message us on Facebook, you name it, email Alexa or myself, and we'll do our best to find a guest to teach that type of subject. And one of the things about Julie is, and I'll let Julie give her background, is that she's amazing, right? So we've been working back and forth on the emails, and she really wanted to cater it to you guys because when I asked her about FIRPTA and real estate investors and all these things, and she's like, well, which part, right? And and Julie, I think you mentioned is like, I could do this for days and days and days. And so I did my best to cut out what we think we would want as real estate investors. And I'm going to leave the floor to Julie. You should be able to share your presentation, and we'll take it from there. And make sure you put your questions in the Q&A. And I'm looking to listen in also. So Julie, the floor is yours.
Thank you, Anish. And thank you, Alexa, too. So just confirming you can see my screen real quick. Excellent. So my name is Julie Lepore, and I am the owner of a very niche accounting firm that only does FIRPTA-related tax work. So here at my tax office, I don't have a single U.S. customer. All of my clients are foreign. They're all from other countries. They all own real estate here in the U.S. I've been doing this for about 14 years. And FIRPTA is definitely, I eat, breathe, sleep, dream, speak FIRPTA all day long, 7 days a week. It feels like 24 hours a day, but um, I do it because I love it. So I have got a really good handle not only on what it means and how it works, but how to get everything through the IRS's system in a really seamless and efficient way, which in my opinion is 90% of FIRPTA. But let's talk about what FIRPTA is. If you've never heard about it, this is a part of the tax code. It's been around since the 80s. And FIRPTA stands for the Foreign Investment and Real Property Tax Act. And it was designed to ensure that foreign owners pay their fair share of taxes just like domestic investors had to. So, up until FIRPTA, there were tax treaties in place where our government encouraged people to invest in the US with big promises that they didn't have to pay any capital gains tax, and somewhere around the 80s, they had a little change of heart, for lack of a better word. And they said, wow, this is really unfair. You know, we really should level the playing field between foreign investors and domestic investors, and everyone should pay their fair share of taxes if they make a profit. And so FIRPTA is the catalyst that requires a tax to be withheld at closing when property sells. So it requires the withholding agent, which in a traditional real estate transaction is going to be the buyer, to withhold up to 15% of the gross selling price. So anytime you purchase property from someone as the buyer, you are required to learn if your seller is foreign or not. And if they are, you have to withhold up to 15% of that sales price. And I would imagine as an investor, if you're purchasing that property for 15 for yourself as an investment, then the full 15% is going to apply. But don't worry, we'll get in all that. So in most cases, this withholding that comes out of the seller's proceeds is sent to the IRS immediately after the closing. Uh, do not pass go, do not collect $200. Like, it just goes straight from the closing table to the IRS. And it's sent to the IRS as a deposit in anticipation of what the seller is going to owe in capital gains tax, right? Because we don't know what that's going to be yet. So alternatively, there is another method called a withholding certificate where the money's still collected from the seller's proceeds, but instead of going straight to the IRS as a deposit, it sits in an escrow account until the IRS responds to this withholding certificate application. But that's only if certain rules are followed, and I'm going to touch on that briefly. The biggest thing about FIRPTA that people don't really understand, this FIRPTA tax, is it's a withholding tax. And so what it means is the seller can be eligible for a refund of any part of the withholding that exceeds their actual tax liability. So if you think about when you file your tax return, right? I mean, you guys are probably not employees, but you might remember working for someone at some point where taxes were being taken out of your paycheck before you got that deposit. And so at the end of the year, you get a receipt, but we don't really call it a receipt, right? We call it a W-2. And it's a record of all the income that you had, all the taxes that were paid on your behalf. And then you take that receipt and you go and you file your tax return. And if you owe less than the money that was collected, you get a refund, right? Not including other, kinds of credits and whatnot, but just if you overpay on your taxes, you get a refund. If you underpay on your taxes, you have to pay more, right? And so FIRPTA is a withholding tax. It's that same general concept of how withholding works. So just to be clear on it, an income tax is actual, it's permanent, it's non-refundable. It's paid by the receiver of the income. So when you go and you file your tax return and you pay your tax, you're paying an income tax, a payable income tax. You owe it, you pay it, you don't get it back. FIRPTA is an estimated temporary refundable payment that's usually paid by the payer of the income. Like I said, in a real estate transaction, that's the buyer. So you pay it, but you might not owe it. And so you're able to get a refund. And it's alarming how many people don't understand that it's refundable, or a portion of it. So because the buyer's the withholding agent, I'm taking a really interesting approach here because I want to really hone in on what the buyer's responsibilities are in a real estate transaction. Because as an investor, you're the one buying these properties, right? So you really need to understand from your own personal perspective what FIRPTA means to you. And so the first thing I want to share with you is a screenshot from publication 515. Publications are basically like the handbooks that the government gives us in order to understand the tax laws. So somewhere somebody came up with this 100-page document that they think people are reading and nobody's reading it, but I'm going to share it with you today. So publication 515 says the disposition of a US RPI, and what that's saying is a sale of a US real property interest. So the sale of real property by a foreign person is subject to income tax withholding under Section 1445. Section 1445 is FIRPTA, right? If you are the transferee, meaning the buyer, if you are the buyer, you must find out if the seller is a foreign person. If the seller is a foreign person and you fail to withhold, you may be liable for the tax. What? That's crazy, right? So this is real. This is coming directly from the IRS publication. I didn't alter it in any way, so you could see for yourself that as the buyer of real estate, it's your duty to learn if your seller is foreign. And if they are, we may have to address FIRPTA. Of course, there's exceptions and some other things that fall into place, but this is how it works. Well, how do we know if our seller's foreign, right? Well, the first thing is we just really need to understand that there's only two categories of people when it comes to taxpayers. Thankfully, right? We don't have 17 different categories. We only have two categories of taxpayers. So you are either a US person for tax purposes or you are a foreign person for tax purposes. And I'm really visual. So I like to see categories because if I'm working with someone and I can kind of assess their situation and I can put them in a category, it's going to help me know what my next step is. So let's look at what a US person is. A US person is a citizen of the United States. Now, that doesn't just mean someone born in the US. It could be someone born in Puerto Rico, it could be someone born in Guam. There are many ways that you can be a citizen of the United States. So, a US citizen is a US person. A resident of the US is a US person. Domestic partnership means an entity classified as a partnership, like a limited partnership, an LLC with more than two member or more than one member. Anything partnership classified as a partnership that's formed in the United States would be a domestic partnership. A domestic corporation just means a corporation formed in the US. Any estate other than a foreign estate, any trust that's not a foreign trust. And my favorite definition of a US person is any other person who's not a foreign person. So I know that's a little bit silly, but also really hones in on the idea that there's only two kinds of people. So anyone who's not foreign in this other category is a US person. So let's talk about what it means to be a foreign person. So what we're looking for is something called a person who's classified as a non-resident alien. And a non-resident alien is just a funny way to say that this individual is not a citizen of the US, because that's what alien means, not a citizen, but they're also not a resident of the US. The United States is not their tax home. They have a tax home somewhere else that they're, you know, pay their normal taxes to. So non-resident alien. So as far as individuals go, someone who is not a US citizen and is not a US resident is considered a foreign person. But when we're talking about entities, it's also a foreign corporation. So any corporation formed outside of the US, partnerships that are formed outside of the US, a trust that's classified as a foreign trust, or an estate, which usually means the decedent was like a non-resident alien. So when we're talking about resident aliens, so I'm going to hop back over to the US person category. That second line, it says a resident of the United States. Well, what does that mean? Does that just mean that you live here? You have to have a house here? Because there's a lot of people that spend a lot of time in the US um, as a visitor, or maybe they come over for business purposes but then they go back home, right? If the United States is not their home, but a resident alien means that the United States is their home. And so a resident alien can be a permanent resident with a green card. It could be someone who passes something called the substantial presence test. So I don't know if you've ever heard of the substantial presence test, but it's a formula, a mathematical formula that our government gives us so that we can calculate the number of days a person is on US soil to determine if they are here substantially, at least enough to be considered an actual resident of the United States, right? So if they are passing the substantial presence test and they're not opting out of it in any way, then a person who passes a substantial presence test would also be considered a resident. And a resident falls under a U.S. person, and U.S. people are not subject to FIRPTA. Only foreign people are subject to FIRPTA. And then there's a bunch of other peculiar things that can happen, like if someone comes to the United States on a visa or some sort of work permit, but they come late in the year and they don't have a chance to pass the substantial presence test, they can make this first year election where they're still treated as a resident on the first year that they arrive. If you have a non-resident spouse, you can make an election to treat that non-resident spouse as a resident for tax purposes by filing a joint tax return and claiming a certain language in your return. And then there's also these other factors that can override the test, like a closer connection form and tax treaties. So I don't want you to be an expert in knowing who's a foreign person and who's not a foreign person because it can be really complicated. I'm going to share one of my favorite stories that I like to share. And I got a phone call. It's been a couple years now, but I got a call from a guy and he said, "Hey, my real estate agent told me to give you a call. I am selling this property in Colorado and I see that there's this 15% withholding and I don't really know what it's all about. Am I foreign?" And I said, "Okay, well, let's start with the easy question. Where were you born?" And he said, "I was born in Texas." And I thought for a second, I was like, "Texas? Texas the state?" Because I know there's a country called Georgia, there's a country called Jersey. Like, is there a country called Texas that I don't know about? Of course not. So I said, "Okay, well, wait a second. You were born in the United States?" And he said, "Yeah." And I said, "Well, did you give up your citizenship?" And he said, "No, I'm still a US citizen." And I was like, "Well, if you're a natural born citizen, why are you asking me if you're foreign?" And he said, "Oh, well, because I've been living outside of the United States. I've been living in Hong Kong for the last 30 years. And so I didn't know if maybe at some point I just become foreign for FIRPTA," which of course is a really legitimate question, but you have a natural born citizen who doesn't know if they're considered foreign or not. Imagine somebody from another country who's not familiar with our tax laws trying to figure this out. More importantly, the fact that it's the buyer's responsibility is just blows my mind a little bit, right? But I will tell you that the government gives us a really easy way to make this determination. So we're going to get to that. But I just want you to understand how complicated it can be to determine someone's status for tax purposes. So let's talk real quick about limited liability companies. Now, and I know that LLCs are a very common way for people to own property in the United States, especially investment properties. There's liability protection, different types of tax treatments, some flexibility there. There's a lot of benefit to having an LLC to own your property. But depending on how this property is set up or how this LLC is set up, FIRPTA may still apply even if the LLC was formed in the United States. So I'm going to break this down into three types of LLCs. There's not actually three types, but I think it's easier to explain it if we just all agree that there are three types. The first type is a single member LLC. So when you are the only member of your LLC or of a LLC, it's considered a disregarded entity. And so what that means is that the entity itself, the LLC, is ignored for tax purposes, right? There's no separation between the owner of the LLC and the LLC when there's only one member. That's what disregarded entity means. So because there's no separation between the LLC and the owner, for FIRPTA, we have to look to the owner to see if that owner is a US person or a foreign person. Because if they are a foreign person or some other foreign entity, we have to address FIRPTA on the sale of this property. Okay. So just because they have an LLC, that in and of itself doesn't mean anything. It's what kind of LLC do they have? Do they have a disregarded entity? Are they the only member? Because FIRPTA will probably apply unless there's some other kind of exception. Now, the other type of LLC is a multi-member LLC. When you have an LLC with at least 2 members or more, the default classification for that entity is a partnership. Now, a multi-member LLC can make an election to be taxed as a corporation, but the default classification is a partnership. And so once the LLC becomes a partnership, FIRPTA no longer is an issue because it's not the owner that owns the property, it's the entity itself. So we have to look to the LLC to see, is that a domestic LLC or a foreign LLC? Where was this LLC formed? Well, it was formed in the United States. Okay, well, as long as there's 2 or more actual members, not a manager and a member, but 2 actual members or more, then FIRPTA doesn't apply because the seller of that property is now a U.S. entity. The third kind of LLC is an LLC that makes an election to be treated as a corporation. So whether you're a single member or a multi-member, it doesn't matter. You can make an election so that the IRS treats your LLC as though it were a corporation. So no more pass-through, no more pass-through treatment. It's just the LLC looks like an LLC. It still has LLC in the name, and probably at a state level, it's still an LLC. But for federal tax purposes, this entity is now a corporation. And when that happens, again, as long as it was formed in the United States, you've got a U.S. seller on your hands again. So what I really want you guys to take out of this is there are going to be times where, maybe you're working with a foreign investor, or maybe you're helping someone to set up an LLC. I don't really know what the situation would be, but we have to be really careful with how we approach LLCs with our foreign investors. First of all, there are certain types of entities that are not recommended for certain countries. So, for example, I'll use Canada as an example. Canada does not have the equivalent of an LLC in their country. And so, because they don't have anything equivalent in Canada, they don't recognize an LLC on the US side. So, unless that structure is set up properly with some sort of like a holding corp or a buffer corporation, it could really cause a lot of problems for them tax wise in Canada. So I just want to make sure that when if you're in this arena where you're helping people set up LLCs, or you're working with people that have LLCs, that you are not offering any type of advice in that department unless you are 100% qualified to do so. Also, the other thing I'd really like to caution you with is sometimes real estate agents, and I realize not everyone's a real estate agent, but sometimes people will give advice to someone who owns property in an LLC to help them get out of FIRPTA, right? So I had a situation a couple years ago where it was a real estate agent, and they were working with a foreign investor who owned property in the name of his LLC, and he was the only member. That real estate agent recommended to that seller to go and file an election with the IRS so that his LLC would be treated as a corporation, because he wanted him to get out of FIRPTA. And it worked. He did get him out of the FIRPTA. And what I mean by that is, when he sold that property, there was no tax withheld on that sale because he's now a corporation. But what the real estate agent didn't realize is that corporations pay 21% tax starting on the very first dollar of profit or gain, right? So if he would have left the property in his LLC, yes, there would have been a tax withholding, but the amount of profit that he had on that sale was below the threshold to actually trigger a tax. So he would have been able to recoup 100% of that tax withholding if he would have just filed the tax return the next year and reported the sale and got his refund. But because he now owns it as a corporation, the corporation had to pay 21%. So he ended up costing his client thousands and thousands and thousands of dollars in actual tax dollars, all because he tried to get him out of FIRPTA, which is a very temporary situation to be in. So I just want to caution you to be very, very mindful to not give that kind of advice unless you are totally qualified to do that. So back to how a buyer is supposed to figure out who their seller is. So there's several exceptions to FIRPTA, and a seller being a U.S. person is an exception. And so I call it the seller exception. But basically, no withholding is required on the sale if the seller is not foreign. Well, duh, right? But how are we supposed to know that? So the transfer, the seller, they can provide a certification to the buyer, letting them know that withholding is not required because they are not foreign. A buyer who obtains this certification is supposed to keep this document in their records for 5 years. So what does that tell you about this exception or about this certification? It's really an important document. You know, if the IRS comes knocking on your door 2 years after the closing and says, hey, you bought this property for investment purposes from this foreign seller, why didn't you withhold a tax and pay it to us? You need to have something in writing. You need to have something in your records, like the seller's certifying he wasn't foreign, to support why you didn't withhold. And if you don't have this document, the IRS can come after you for the tax that was owed on the sale of that property. So unless the buyer has actual knowledge that the seller is lying, they can rely on the affidavit in whole. I like to call it the golden ticket of FIRPTA, because you're either foreign or you're not. So if you're not foreign, that's great. If you're not foreign, that's awesome. Just put it in writing so I've got something in my records, right? And and then if the seller is lying, that's not my problem as the buyer. I'm not responsible for a buyer or for a seller who perjures himself as long as I don't have any, knowledge or proof that he's lying, right? Now, as the buyer, the IRS doesn't make me get the certificate from the seller. I can rely on other means. But if I rely on other means and I'm wrong, well, now I'm back to owing the tax again. So why would I take a chance? If you're not foreign, awesome. Give me my certification. Let me keep it in my records and let's proceed. But if you can't give me that document because you're not eligible to sign it, or because you don't have a tax number, or because you're not a US person, in theory, that's how the government expects the buyer to know that they have to withhold, right? So if the seller is not foreign, he signs the affidavit, no FIRPTA. If he can't sign it, then FIRPTA applies. And so now we have to assess the situation to see if we can rely on some sort of other exception. Any questions about this? This is kind of an intense concept because everyone's thinking, oh, well, I'll just buy this property. It's no big deal. And as long as nobody says anything, then we're good. But it's really the quite opposite of that. We literally have to assume that every seller is foreign, that every sale is subject to FIRPTA until they prove to us that it's not, either by certifying that they're not foreign or by qualifying for some other exception.
So, Julie, I do have a couple questions.
Sure.
One is from Libby. Can a domestic partnership corp include a foreign person and then consider that person a U.S. person?
Okay, so I'm not trying to pick on Libby, but I'm going to use this as an opportunity. So one thing she said is a partnership corp.
Yep.
So it's so very common for us to use LLC and corporation interchangeably as
Yep.
though they were all kind of the same thing, and they're not.
Yep.
So if there's one thing that you guys take away from me, I just want to encourage you to not use those terms interchangeably because you could get false information. So if you call
Yep.
me and say, "Hey, I've got this corporation, it's formed in Florida, does FIRPTA apply?" I'm going to say no because you said corporation. But if you really meant LLC, I should have asked 10 more questions, right?
Correct.
And so those questions I should have asked is it formed in the United States? How many members are there? Are they actual members? Because sometimes, like if you go on Sunbiz and you'll see this, you probably know what I'm talking about, but you can go on Sunbiz and you can look up an LLC and you can
Mhm.
see who the members are. And sometimes it'll say member, sometimes it'll be manager, sometimes it'll be something else. And you can't just take Sunbiz's word for it because Sunbiz is a state operated website. It has no bearing on how an entity is taxed at a federal level. So back to Libby's question, what I think she's meaning is, hey, if my LLC has two members, but one of them is foreign, then what? And we don't care who the members are and what their status is as long as there's two or more. So as soon as we know that it's a bona fide partnership, it's an LLC, a multi-member LLC, that's the end of the questions. We only
Yeah.
care where that LLC was formed to determine if it's domestic or foreign. We don't care who the members are. The only time we care who the members are of an actual LLC is when there's only one.
Yep. And that's what she meant. She actually sent she meant partnership and or corp. So
Okay, perfect. Well,
yep.
I knew what she meant, but I was like, oh man, this is such a good opportunity to like talk about this because
Yep.
it happens 99% of the time, when people are asking me, hey, can you help me figure out, if
Yeah.
this seller's foreign or not, or what do I need to do with this corporation? And then I look at the documents and it's an LLC. So
Yeah.
I didn't mean to pick on her, but it
Yeah.
was really
So
good. It was really good
can I
timing.
come I'm gonna come clean too. I used to do the same too. So
Hey, listen,
so you
admitting
could
it
say,
is
hey,
half the
Nish.
battle, right?
And the thing is, like, listen, when you're not, the great thing about having you on, or like a Kevin or some of the people we have, I'm not an expert in this field, nor do I want to be one. I have
Hmm.
you, right?
Yeah,
And that's the whole point of it. So for the people that get confused today, you're not going to become an expert on this in 45 minutes or an hour by any means.
for
Today's
sure.
just an overview of how it really works, what
Yeah, and
questions and how the process works.
and even before that, just creating an awareness that it exists,
Correct.
you know?
Correct. Yeah, and
Um,
I mean, I think I like the one thing that you already pushed on. It is up to the buyer to figure this out, right? A lot of times,
Wild, right? Isn't that
yeah,
crazy?
yeah, you would think it's okay. Why do I have to deal with this, right? So, I kind of crack up on this too. And Char's actually asking, should we? So we should be asking for the affidavit with every transaction.
In my opinion, absolutely. Or at least coming up with a plan of when you can expect to receive it. Because, a lot of these, we're talking about real estate sales, right? And so a
Yep,
lot of these sales are happening through a title company or a closing agent or a closing attorney. And many of them have procedures in place where they have their sellers sign something like this as part of the closing. But it gets signed at the closing table.
yep.
You know what I mean? And if I could tell you how many times I get phone calls from the closing table, like, oh my God, FIRPTA applies. Like, we didn't know. I had one closing a couple years ago from someone here in Cape Coral. She called me. She's like in a panic. Julie, you have to help me. We need I-10s for these sellers. And I said, okay, no problem. When's the closing? She's like, it's right now. And I was like, right now? What do you mean it's right now? Like, how did you not know that your sellers were foreign? This is what she said. She said, they didn't sound foreign. They didn't sound foreign. Like, and
Wow.
it's not even an isolated incident, to be honest with you. And it's not that anyone's trying to do anything malicious or wrong
No.
or, evade the tax or anything like that. It's just no one's thinking about it. And using someone's accent as a determination of whether or not they're foreign is like not
Yeah.
sufficient. Every
You
people have
think?
accents all the time, right? Florida is a melting pot of
Yeah.
of just beautiful people from all over the world. Of course they're going to have an accent. That doesn't mean that they aren't citizens. That doesn't mean that they don't have green cards. That doesn't mean that they're, been living here for 20 years or, doing their thing or whatever. We can't use that as a factor.
Yeah.
So we just have to be taking this seriously. And, again, I know not everyone's a real estate agent here, so I'm being conscious to remember that. But when we buy and sell real estate, we do use contracts.
Yeah.
And if
Oh
you
boy.
look in the contract, there's an entire section in there on FIRPTA. And I bet if you read it today after you've gone through this class that you're going to be seeing things with such fresh eyes. Things are going to really start making sense to you because the very first sentence, and I've actually got, let me just jump to it real quick because I included the real estate contract in here. I have to be careful because I'm not an attorney, so I can't give contract law advice. But if you can just read this first sentence together, it doesn't even require any interpretation. It says if a seller of U.S. property is a foreign person as defined by FIRPTA, it requires the buyer to withhold up to 15%. No withholding is required under Section 1445 if the seller is not a foreign person. That's what we just talked about. The
Yeah.
seller can provide proof of non-foreign status to buyer by delivery of a written certification signed under penalty of perjury, stating the seller is not a foreign person, containing their name, their tax ID number, and their home address. Look at the last sentence. Otherwise, buyer shall withhold.
Mm,
So if it's in your contract and the contract is the very first, what's the first step in a real estate transaction? It's the contract,
yeah.
right? So if you're going to talk about radon gas and you're going to talk about, HOA associations and you're going to talk about
Base.
lead-based paint, you really need to talk about FIRPTA. And
Yeah.
you can just say, like, what about this certification? Is this something your seller's going to be able to provide sometime between now and the day of closing? Because if not, we probably need to do FIRPTA. Or if not, we need to get someone involved and see if we can use one of these other exceptions. That's all it really needs to be. You don't even have to know anything else beyond that, except for if you can't get your certification, FIRPTA probably is going to apply to this transaction.
And I know you mentioned, I mean, I got my own questions too. So this is the great part when you run a webinar and you get to ask some of your own questions. I know you kind of touched on the fraud. I mean, I love Florida, especially South Florida, the fraudulent side. Uh,
Uh-huh.
as the buyer, how are we protected if they're fraudulent on the other side? How do you do, what's the distinction on that? Is there something else that we could really, I mean, I know they're signing and they're saying, is there any additional steps we could really, I don't know, best practices probably is what I'm gonna ask
So are you talking about like specifically for FIRPTA
for FIRTA,
in the
yeah,
event when, like a seller signing off on this affidavit that he's a US person and like you're just
correct.
supposed to trust him?
Yep.
I mean, if you did dig a little deeper, where would you stop?
Yeah, yeah, yeah. I was just curious if
No,
there's
I mean, I talk about this all the time because it's really I think it's a cool concept to like really think about because you're right. Like, how do we really know? And
yeah,
that's why using this certificate is such a brilliant idea and should be our go-to every time because this is all that the government says we need to do,
got it.
you know?
Yep.
And so if we didn't rely on this and we had to rely on our own devices, like we'd have to look at birth certificates and
Yep.
passports and tax returns and hire a forensic accountant to like make sure
Yeah,
that they were real and filed with the IRS and maybe hire a private investigator to like follow the guy around town and see if he's got children and goes to church and where he does his grocery shopping. You know what I mean? Like it would be
yeah,
so
yeah,
invasive and it would be such a an invasion of their privacy. Like thank
yeah. I,
goodness
I, I guess
IRS
also,
doesn't
I mean, if you
expect
think
that.
about it, I mean, it could be fraud whether they're, a US person also, right? I guess it
Yeah.
runs into the same end of it. It's just that them signing that certificate, and yeah, at least you have the certificate, and like you're saying, we could show, hey, we did our part. I can't
You
help it.
did your part.
Yeah.
Yes.
Okay.
Yeah. Now, as far as fraud, like if are you talking about like identity fraud and impersonation fraud when it comes to
Not
foreign
really.
sellers?
It's more
Okay.
the more the FIRTA stuff. Like, hey, I mean, hey, I signed saying I'm a US person and I'm
Mhm.
not. So okay, yeah, I just wanted to make sure if there's anything else, they sign it, they sign it. I guess,
Yeah,
that's what
I
it
mean,
is.
and I'll be honest with you, I've seen people go a little bit crazy, like trying to get to the bottom of someone's status. And
Yeah.
it's gotten so bad that we actually at our office, we do what we call resident alien assessments. So
Okay.
obviously when someone's a US citizen, that's really easy to prove. If someone's got a green card, that's really easy to prove because they have a green card. And I'll tell you, like from a due diligence point of view, title companies and real estate attorneys that are doing these closings do usually ask for some sort of ID or some sort of proof. So it is kind of being handled. It's not
Right.
consistent, so I have a really hard time saying, that it's going to be the same every time, but um there
Yeah,
are
I know Kevin at Independence does.
a
So
100%,
yeah,
a
so
hundred
if
percent.
you guys are using Kevin Thatcher, one of our speakers, also on the 2-day quick start, you always see him at the in-person meetings. They got your back. I'll leave
Yeah.
it at that's probably the
And we
easiest way to
do
put it.
like he turns to us every time they have a potential FIRPTA transaction to really find out if we have to do it or not. So,
Yeah,
that's another thing is just making sure that you're working with the players in the game that are taking this seriously,
yep.
you know.
I got another question, and actually, so hey, Jose. So Jose Ramirez, who I was telling you, Julie,
Oh
our
yeah, you were
chief
telling me.
tax
Hi, Jose.
strategist, our guy that's been with us for 10 plus years. So he's actually got a question. He says, "Does the substantial presence test apply to determine if a seller is a U.S. person?"
Absolutely. Yeah. So that is definitely one of the uh criteria, when someone's not a US citizen and they don't have a green card, the only other way that they can be a resident is by passing the substantial presence test. And if you just jumped on, you probably missed my screen about, like the non-resident spouse election and the first year choice. Obviously there's some other rare instances where it would override that. But the substantial presence test is a huge factor in determining whether someone is a resident or not. So in my world, though, what happens is I get a lot of people, especially I'm in South Florida, so I get a lot of Canadians, a lot of Germans, and they are here temporarily. They spend a lot of time. They maximize how long they can stay. They're usually here, 175, 180 days, um, never going over the 183 mark. And they don't even realize that they are passing the substantial presence test, right? They don't realize that they are. And so for someone who accidentally is, and it's not intentional, the problem there is that if our government ever caught wind of that, they would treat that Canadian visitor as a US resident. They could force them to file back tax returns, report all their foreign asset accounts. Like it could really be a nightmare. So people in that situation, especially Canadians, they call it the snowbird form. There's this form that they have to fill out every year where they acknowledge that they spend a lot of time in the US, but they opt out of being taxed as a resident. So that's something I have to be mindful of when I'm helping to determine if people are foreign or not is, especially, because nobody wants to go through the FIRPTA process. Nobody wants to pay taxes if they don't. No one wants to have 15% of their sales price withheld. So a lot of times people will call and they're like, hey, I spend a lot of time in the US because, I vacation there a lot. I think I'm a resident. And it's like, well, you probably are based on the substantial presence test, but do you know what that means to be a resident? Like, you can't just be a resident for FIRPTA and a non-resident for all the other tax matters. It's an all or nothing situation. And so once people realize what it means to be a resident, even if they're passing the substantial presence test, a lot of them will instantly start filing that 8840 so the government can't come after their income in their home country, right?
Yeah, makes
So I don't,
sense.
so I don't know if I answered your question, Mr. Ramirez, but the substantial presence test absolutely is a huge part in determining whether someone is a resident or not.
Yep, and he said you did, and excellent. I'm gonna one more question before I let you go back on your presentation.
Yep.
Alejandro is asking, if I'm not mistaken, when a seller is a natural person or non-resident, they need to apply and get assigned a temporary tax ID for the tax filing and retention.
Yeah, so when somebody is not eligible for a social security number, like most foreign nationals are not eligible for a social security number, they still have to have a number in order to go through this withholding process. So that number is called an ITIN. It stands for Individual Tax Identification Number. There's 13 valid reasons that you can apply for this number. So you have to qualify for one of the reasons. You can't just wake up on a Tuesday and go get one. And so FIRPTA, having to go through the FIRPTA process is definitely one of those valid reasons. So when someone sells the property, we have to get them a number. We have to connect that number to the money so that the government will issue them a validated receipt. And then once we have that receipt, then we can file their tax return the next year, show how much tax they really owe, and that's when they get their refund.
Makes sense. Absolutely. And I'll let you get back to
Okay.
and then we'll have some more time at the end for more questions, guys.
Okay, perfect. So staying along the same lines of my buyer responsibilities, just so I can kind of hone in like what the rules are. The other buyer responsibility besides determining if the seller is foreign or not is figuring out if there's any other exceptions that apply. And so we did talk about the seller exception, right? I call it the seller exception, and that's when the seller's not foreign. So again, I just want to hone in on this principle real quick is that being a US seller is considered an exception to FIRPTA. It's an exception to FIRPTA to be a US seller, not the other way around. So you have to go into every transaction thinking that your seller is foreign until he's not. Another exception is purchase of a personal residence for 300,000 or less, which I'm going to explain on the next screen. If the buyer is a government, like the state of Florida or the US government, FIRPTA doesn't apply no matter who the seller is. If there's no consideration paid, so if somebody, transfers, like gives a property to their grandchild as a gift, FIRPTA doesn't apply, but gift tax does. There's this thing called non-recognition of gain, which I'm going to explain mostly as it relates to a 1031 exchange, and then a withholding certificate. So withholding certificates, I'm not really going to spend a lot of time on, and I'll tell you why. Withholding certificates are applications that a seller can make before closing where they're asking the government to reduce the withholding down to a percentage of the profit instead of a percentage of the sales price, right? If I sell a $500,000 house, what's 15% of that? $75,000. Well, what if I paid $400,000 for the house and I put $50,000 into it? Now my profit's only $50,000. Why should I have to pay $75,000 if I'm only going to owe 15% of that, right? So you can do this withholding certificate. But the problem with the withholding certificate is the processing time. So before COVID, the IRS was processing these applications in 90 days. So that means as a foreign seller, you could sell your property, pay the $75,000, it's sitting in escrow somewhere. The IRS would respond 3 months later and say, "Oh, we don't want $75,000. We only want 5,000." So then the escrow account gets dispersed and $70,000 goes to the seller and only $5,000 has to be sent to the IRS. It's a beautiful, beautiful product. But now, ever since COVID, ever since 2021, actually, the processing times have gone from 90 days to 18 months. So I don't even recommend withholding certificates anymore because it actually delays when a seller can get a refund. It doesn't increase that. So it delays the refund, but withholding certificates are still a thing if anyone ever mentions it. So let's talk about the buyer exception. We talked about the seller exception. Now let's talk about the buyer exception. So no withholding is required. So if your seller is foreign, you still don't have to withhold if the buyer is an individual, not a trust or a corporation, and they are acquiring the property for use as a personal residence. What that means is the buyer has to have definite plans to reside at the property for at least 50% of the total occupied days during each of the first 2 years. Notice I didn't say 50% of the year. They don't have to be there 6 months and one day. They don't have to be there 9 months, or it's not the year that matters, the number of days in the year. It's the number of days that the property's occupied by anybody. You don't count the days that it's vacant in the calculation. And it's occupied by the buyer or somebody in their immediate family, like a brother, a sister, a child, a grandmother, mother, something like that. So let's say, for example, let's say I'm purchasing property from a foreign seller. I'm going to buy a condo. It's $250,000 and it's in the same community as my house, and I'm going to buy it for my parents to use when they come visit my children, when they come to visit, so they've got their own space. Well, I'm the buyer. The sales price is under 300,000. I'm buying it in my individual name, and I'm buying it for an immediate family member to use. So whether my parents stay there 6 months a year, 3 months a year, 2 weeks, 7 days, or all year long, it doesn't matter, because when they're not there, they're not going to rent it out. So they are using it 100% of the time that it's being occupied, and you only have to use it 50% to qualify. So what that means is I could technically, if I wanted to, rent it out for a couple weeks in the winter or a couple weeks in the summer. As long as my parents ended up using it more days, it still counts as personal use. So it's really important to me. I think this exception has a lot of misunderstanding around it, and I think that if we understood it more, it would open up our pool of buyers and give us more opportunities to take care of these transactions without having to go through the FIRPTA process. But there's this misconception that it has to be the buyer's primary residence, or that it has to be qualify for homestead, and none of that's true. If the buyer doesn't maintain the minimum number of days that they said they were going to in order to take advantage of this exception, they could be held liable for the tax if that seller ends up not filing a tax return. So put this in perspective. It's the sale price is under 300,000. I'm the buyer. I'm using this exception, so there's no withholding. And so now the seller is on the honor system, basically, to file a tax return and pay whatever capital gains tax that they have. FIRPTA is just a tax withholding. So if we can avoid that because of an exception, that doesn't mean the seller doesn't have to file a tax return. It just means that the tax didn't have to be paid in advance. So if I end up not using the property the way I said I was going to, I could be held liable for the seller's tax if he ends up not filing a tax return and I end up, you know, not using the property this way. Now, there's a little rule in here that says if I don't end up using the property the way I was going to because of a change in circumstances that I couldn't have avoided or known at the time of sale, then I'm not liable. But the government hasn't really defined what those unforeseen circumstances are. We think it's the big things, death, illness, marriage, divorce, that kind of thing, but they have not technically defined it. So just keep in mind that this exception exists, but it does carry some risk to the buyer if they are truly not going to use the property this way. Let's talk about the non-recognition of gain. So there's this non-recognition of gain is it's an exception. And so there are different parts, different elements to the tax code where sellers don't have to recognize gain or loss. Um, in a traditional real estate transaction, really the only one that kind of fits the bill here is a 1031 exchange, and not even a normal 1031 exchange. It's a FIRPTified 1031 exchange. And so there's this misconception that when a seller does a 1031 exchange that it automatically prevents FIRPTA, and that's not true. It's not automatic. It's possible. It's possible to use a 1031 exchange as an exception to FIRPTA, but it's not automatic. Okay. So if you don't know what a 1031 exchange is, it's a way for a seller to sell an investment property, not a second home or a primary home, but it's a way for an investor to sell an investment property and take all the capital gain that they would normally owe tax on and move it onto another property. So basically, you sell one property, you take all the proceeds, you purchase another investment property, and as long as you don't take any of the cash out, and uh, a like kind exchange, then you don't have to pay taxes on the property that you sold. Instead, it just kind of gets rolled into the next property. And you keep doing that and you keep doing that until eventually you sell the property. And then whatever capital gains tax you owe at that time, you would pay. It's an awesome tool. It's a great tool for investors. But when the investor is foreign, there's this whole nother level that has to be addressed. So it doesn't apply to FIRPTA unless the sale happens very quickly. So in a traditional exchange, so forget about FIRPTA. In a traditional exchange, you've got 45 days to identify a new property and you've got 180 days to close on it. That's all fine and dandy. That still exists. But if you're trying to use the exchange to get out of FIRPTA, you don't have that same time limit. You have to sell the old property and buy the new property before the buyer has to submit the tax. So basically, you've got less than 20 days to pull this off. And if you are going into the sale and going into the exchange knowing that you have to find a replacement property quick, then you can pull this off. I mean, I do this on the daily. I do these certificates for people that are doing these simultaneous closings. But you have to sell the old property and purchase the new one in 20 days or less. And the exchange has to be completely tax deferred. There can be no boot. So boot is a term that we use in a 1031 exchange for any amount that's taxable. So sometimes someone will say, "Oh, well, yeah, I want to sell my investment property for $1 million, but I want to downsize. I want to buy this condo and make this condo a rental, and it's only 600,000." Well, when you go from $1 million to 600,000, you've got a portion that didn't get reinvested, and so that's taxable. That's called boot. You can't have that if you're trying to use the exchange to get out of FIRPTA. So it has to be completely tax deferred. You can't pay off credit card bills. You can't pay off solar panels. You can't, uh, you know, take $100 for yourself. Nothing. It has to be completely tax deferred. Now, if the 1031 exchange can be pulled off like this, if this whole thing can be arranged and orchestrated, then FIRPTA can be avoided, but the seller still has work to do. They have to prepare a detailed notice explaining to the buyer why the transaction doesn't require FIRPTA, and then they have to give it to the buyer in time for the buyer to turn around and submit it to the IRS within that same 20-day period. So because there's so much that has to happen in this 20-day period, usually when we're trying to do this, sellers don't get the full 20 days. It's usually like 14 days. That's the comfort level that people have with this. Because if they can't pull it off, the money's got to be collected. It's got to be sent to the IRS in a traditional way. So like I said, if the 1031 exchange doesn't work out like this, if they can't orchestrate this quick closing, then we have to deal with FIRPTA. And so what that means is 15% of the sales price is going to come out of those proceeds, and it has to be sent to the IRS. Well, what does that mean? The whole point of a 1031 exchange is to take all of the proceeds and put it into a new property. But if you've got 15% coming out for taxes, that is going to be considered boot. That portion is going to be taxable. So what a lot of foreign investors do in a situation like this, when they don't want to pay any tax on the exchange, is they will fund it. They'll add money, their own money to the deal. They will basically fund whatever the FIRPTA withholding is. That way, when they get a refund the next year, it's their own money they're getting back and not sales proceeds. And that's what keeps the exchange tax free. Buyer responsibility number 3, they have to figure out how much to withhold. Well, we know it's 15% of the sales price, but it's the amount realized. And so the amount realized can mean a couple different things. It could be the cash paid. It could be the fair market value if people are exchanging properties. It could be the mortgage that somebody assumes. So sometimes people will be in distress and they'll say, "Hey, you can have my property, just pay off my mortgage, whatever my mortgage is." And so the investor will pay off the mortgage and they become the new owner. Well, whatever they paid off is the consideration paid for that property, and that's the portion that's subject to FIRPTA. So there's a lot of different ways that FIRPTA can apply that we're not really paying attention to. Also, it applies to assignment of contracts. So if the seller sells to person B and B sells to person C for like an assignment fee, if B, the person here, if their foreign FIRPTA applies to the portion to the fee that they're receiving. So it's another way that FIRPTA can apply. So how much is withheld? It's 15% of the amount realized, which in a real estate transaction is typically going to be the contract price. But it really depends on who the owners are, because you'll have situations where you have multiple owners where some of them are US, some of them are foreign. I had a deal one time with 42 beneficiaries that were going through like a probate process. Some of them were foreign, some of them were not. So it was really wild. But we have to allocate the amount realized among the transfers based on their capital contribution, unless they're married. If they're married, it's automatic 50-50. But if they're not married, it's based on their capital contribution. So what that means is, let's say you've got 5 people that bought a condo a cabin in Tennessee. So you got 5 people that bought a cabin in Tennessee, and one of them's Canadian. Well, if they all paid equally for this property, if they just split it when they sell, they're all getting equal shares back. So in theory, 20% of the sales price would be subject to FIRPTA. But if this guy paid 50% and this guy paid, 30% and the rest was split between them, it's whatever their capital contribution when they sell, that's what they're going to get back. So that's the portion that's subject to FIRPTA. Um, and if the seller doesn't tell you that it's unequal shares, then you have to just assume it's equal shares and you just withhold on that foreign seller's share. Something interesting though is you cannot allocate 100% of the sales price to a US person to avoid FIRPTA. So let's say that there's 2 people on title and one of them's US and one of them's foreign. The US person can't say, "Oh, well, just give me all the proceeds because I'm US and then we don't have to do FIRPTA." No, you cannot allocate 100% of the proceeds to just the foreign person to get out of FIRPTA. Buyer responsibility number 4. What are the deadlines for submitting the funds? So now we know our seller's foreign. Now we've collected 15%, or the closing agent collected 15%. Now what? Well, the money has to be sent in, and when it gets sent in depends on how we handled it. So if a withholding certificate was not applied for, which this is 99% of the time these days, the funds that are collected out of the seller's proceeds have to be sent to the IRS within 20 days. After day 20, on the 21st day, the buyer's going to get hit with a failure to pay, a failure to file, and interest that compounds daily. I have seen penalties as high as $180,000 before. Not withholding, but actual penalties for late payment, $180,000. And what happens when you can't pay your taxes? The IRS will garnish your wages. They will seize your assets. They will put a lien on your property. They will do whatever they can to get that money. And who owns the collateral now? The buyer, right? So this is a very, very real thing that's happening. Now, if a withholding certificate is applied for, the funds get to stay in escrow, but only if there's evidence that the withholding certificate was applied for on or before the day of closing, and they've put it in writing to the buyer that they've made the application. So without those 2 things, the buyer has to send the money come hell or high water, right? And then the money gets to stay in escrow until the IRS responds. Well, remember, it's taking about 18 months for the IRS to respond. So that means a year and a half after that buyer acquires that property, the IRS is going to be sending a letter that says, "Hey, we've approved your application. You don't have to send us all 15%. We only want $1,000, or we only want $10,000. So a year and a half later, the buyer's going to have to get involved again, because now some of the money that's been sitting in escrow has to be sent to the IRS. So what can we do? How can we be more proactive? What can we do to make sure that these transactions are going as seamless as possible? The first thing is my big passion statement. You have to consider that FIRPTA applies to every transaction until it's proven that it's not required. If we go into the transaction thinking FIRPTA, we're going to catch more of these sales that really there needs to be a withholding. If FIRPTA is required, sort out the details early in the contract. Don't wait for the closing agent to do it. Don't wait for someone to tell you that FIRPTA applies. Be proactive. Your clients need you to be a hero, right? And if you are the buyer, you need to know what's going on so that it's not this last minute nonsense that's happening at these closing tables. Familiarize with the FIRPTA section of the real estate contract. Understand what the options are. Understand what the exceptions are. Understand how it works if somebody wants to apply for a withholding certificate. Keep the lines of communication open. It's not just a one conversation thing. It's a, "Hey, FIRPTA applies. What's being done about it? What are you going to do? What are we supposed to do? Hey, we're almost to closing. Did those things get done? Hey, closing happened. Did the money get sent in?" It has to be something that's communicated. And if you don't want the responsibility of doing all that communication, you have to hire somebody like me so I can manage that process. That's exactly what we do. We step in and we manage that piece of the closing. We don't care who we represent, buyer, seller, we care about everybody. If it doesn't go right for the seller, it's a problem for the buyer. If it doesn't go right for the buyer, it's a problem for the seller. They rely on each other. So every side has to be protected and it has to be submitted properly. provide regular updates, work with tax professionals that know what they're doing. And Mr. Ramirez, I'm sure you can vouch for this. And there's a lot of great accountants, there's a lot of great attorneys. Um, if they're not doing FIRPTA every single day, they have to stop what they're doing. They have to read the instructions. They have to learn the process. They have to learn the regulations. They have to do this. They have to do that. And they're going to miss something. Just like me, like I only do FIRPTA. I'm not going to do an estate tax return. I'm not going to do payroll. I'm not going to do reconciliation or, that's not my thing. That's not what we do here. So FIRPTA is a very specialized situation. You have to work with someone who gets it, right? And one of the things that we are really proud of is because of the way our firm is set up, because we don't rely on annual clients. I don't have repeat clients. I don't want I don't want to do the tax returns. I don't want to have annual clients. So we work really well with CPAs and other tax advisors so that we can just do the FIRPTA piece or sometimes the I-10, like whatever is needed, but we can just do the FIRPTA piece, and then that accountant gets to keep and maintain that relationship. So don't feel like if you already have an accountant or you already have a CPA or you already have someone that helps you with your tax return that you can't still call us about FIRPTA because we work in tandem. We have so many relationships with CPAs and tax attorneys too, where we're just handling this piece because we can do it so efficiently and so affordably, right? So we're not a greedy group. We've kind of talked about the contract, but your homework today is if you are in a world where you are working with real estate contracts, please just take 5 minutes to kind of read through it with some fresh eyes. I hope you pick something up today where when you do read that, it's really going to hone in like what those sentences mean. I'm not an attorney. I can't give legal advice, but if you have a question about how FIRPTA works there, let me know and I'll be happy to explain it to you. These are some of the services that we offer, and this is my contact information. So I'm free for some question and answer if anyone has any.
Yeah, I got one here from Eduardo. So he's saying on the buyer exception slide, it states buyers must be an individual. If a
Yes.
single member LLC is disregarded for tax purposes to the individual owner, can a SML LLC still use the exception if occupying the property?
No, absolutely not.
Short and sweet to the point.
Yep.
Let's see.
And that comes directly from the tax code. The IRS specifically mentions that the buyer has to be an individual, not a trust corporation or, yeah.
Awesome. If you, Carlos is asking, if you own two or three houses and lived on them for more than 2 years, when you sold, do they apply for the owner exception?
So it's not so much, I feel like there's a little mix up here. So the residency exception, is that what we're talking about? Where the buyer can say, I'm going to use this property for personal use, and so we don't have to withhold. It's not how long the seller had the property or how the seller used or occupied the property. It's how their new buyer is going to occupy the property.
Makes sense. Yep.
Yeah.
Okay. Those are
Which
some
is
of the questions.
crazy, right? Think
Yeah.
about that. Why would the seller's tax liability have anything to do with how a buyer is going to live in a property? You know what I
Yeah.
mean? Like, and the fact that using the property for personal use at 300,000 can eliminate the tax withholding, like that just
Yeah.
is bizarre to me. But
Yeah. I'm going to ask
that's another webinar.
absolutely. I'm going to ask a totally off um, mark kind of question myself. Obviously, with the new presidency, are you seeing or have you heard any whispers? Obviously Donald Trump being a real estate guy. Um, have you seen any kind of proposed legislation or as I said, whispers on this portion of FIRTA or anything that's been mumbled, I guess is probably what I'm going to say.
I
That
mean,
may
not
affect me.
not really.
Okay.
I am seeing a lot of foreigners sell right now.
Yep.
Just because they are very uncomfortable with how they are internalizing all the changes that we're going through. It's making them very nervous and they don't know what the future is going to hold. And they're worried that someday they won't be able to come back into the US and be able to enjoy their properties. And so a lot of
Mm,
them are selling out of fear. Um,
okay.
the other things that we're running into is, there's a lot of people that are living in the United States, undocumented, and they're living here, they're working here, they're raising their families here, and they pass a substantial presence test. And so they're considered a resident for tax purposes. And
Mm,
so, when I'm working with somebody to try to determine if they are a resident or not, immigration is not a thing for FIRPTA. FIRPTA doesn't care if you're here legally or not legally, or if you're documented. They just care if the United States is your tax home and if you're living here and passing the substantial presence test, which I know sounds a little crazy, but you can still be a resident even if you don't have the proper paperwork in place. And so for
mm,
me, when I'm trying to assess people, sometimes I have to ask awkward questions and they get very nervous because they don't trust my intentions. And
correct.
so that's really the only kind of like difference I'm seeing from like a customer service point, is that people that are undocumented would rather go through the withholding process when they don't have to than answer questions about their status, because they feel like maybe I'm going to record it or maybe I'm going to tell somebody, or something
Mm,
like that. So that's really the only thing that I'm noticing, but I haven't
okay.
heard anything from a government perspective as far as like any changes or anything that would have any bearing on the FIRPTA rules as we know them.
Okay, got it. And then obviously, at BPM RIA, like I don't get into politics or religion, or I do talk a lot of crap on sports when my teams win or lose, but that's a personal issue.
Yeah.
And I was just asked because there's a lot of new legislation, like from on the accounting side that might be for depreciation or some of the other things that they're talking about. So I don't just for me, I was just kind of curious on that end of it. I do have another question that just popped up.
Okay.
How does this apply to transfer of mortgage notes? Does that apply, first of all?
Um, I would need more specifics on what that means to the person asking the question, so they can call me or send me a message and give me like the details of the type of transaction that they're talking about. And then I'd be happy to respond.
Yeah, and I always tell people because I know we have a lot of viewers, and first of all, Julie's taking the time out of it. Um, specifically even on that question, like hopefully you have a real deal that you're looking at, like the ifs and what happens kind of questions. I get a ton of those. It sometimes it becomes a little too much. So if you do have specific things that you're looking at, it is that's when I would reach out to Julie, is what I'd rather do, because I don't want to all of a sudden you get 100 calls and emails. What about this or what ifs in general? So just based on your time, we're actually out of time. Those 90 minutes went pretty fast as
Told you I can talk
usual.
forever about it.
By the way, you made it as interesting as possible
Thank you.
for FIRTA. I mean, before I was like, it's like, talking about tax law, like, oh my gosh. And I learned a ton of stuff too. So I want to thank Alejandro for suggesting this. This is the first time we've even ever talked about this topic at BRIA or BPM RIA with a true expert. So I want to again thank you very much. I know Alexis, someone got paid
I
to show
do
up today.
have a winner. All right, guys. My winner for the 1 year membership is, congratulations, Legend A. Whoop, whoop. I'll get
Ooh,
it
go
sent to you.
legend.
I'm so happy for you. And also, Julie, thank you so, so much. That was insane. And I hope we get to meet you in person, maybe at one of the networking, or have you back. So thank you again for
Yeah.
the time. I
Yeah,
really
we'll
appreciate
definitely have her back. And again, I did put a link in there. So make sure you give us a 5-star Google review. And again, whatever one thing you learned at Julie's presentation, If you don't give us a 5-star review for Julie, I'm not going to have her come back. No, I'm kidding. I'm only playing. I'm only playing. No, we really appreciate it. And again, if you have any other topics, first of all, Julie's a wealth of information. So there's some other topics within that that Julie's a true expert on that we could always look further down the road too. So
Love it. Love it. Make sure you
Yep.
guys can find her, and I will send each and every one of you a thank you email. Look out for my email. I'll have links in there for you. Look out for the replay. Go share it with somebody. And I hope you guys have a great rest of the week. We will see you back this
Tuesday.
actually students, mentoring students. You guys have a support class this weekend. So coaching students, you guys know you have that support class, but next week on Tuesday, we'll see everybody else. So have a great rest of your day. And
Yep,
Carlos, go ahead and text me or email me and I'll send you the.
absolutely. So thank you guys. Thank you, Julie.
My
Thanks for
pleasure.
taking out the time, and we'll see you soon.
All right. Take care, guys. Bye.
Bye.
Bye.